stage is set. All engines go. Welcome to the angle. Let's start the show. Hold on tight. The stage is set. Dig in deep with no regrets. Red and green bars leading the way. Welcome to the angle. No time to delay. Markets rise and markets fall. Atomcash is ready to answer the call. While the bulls charge hard and the bears dig deep, the angle will keep you on your feet. Hold on tight, the stage is set. Dig in deep with no regrets. Red and green bars leading the way. Welcome to the angle, no time to delay. Cashing in on the highs and lows where the wind of fortune constantly blows. No looking back, keep your eyes on the prize. Fuel to run with a fire that never dies. Hold on tight, the stage is set. Dig in deep with no regrets. Red and green bars leading the way. Welcome to the angle, no time to delay.
Good morning, everyone, and welcome to the most entertaining, intellectually stimulating financial podcast in the entire world. This is the Atomcash Angle, the show that flips the switch and floods the system with straight financial voltage. I'm Adam Cash, and I'm bringing you the firepower your financial life may have been missing. Now, whether you're new to trading or a trading savant, I am to turn complexity into clarity with a shot of adrenaline. Now, today we have an exhilarating lineup of segments to give you guys as much information as quickly as possible as per usual. Now today we're going to do some live market analysis, potentially some trading. We'll see how Monday goes. You guys know how Monday would take it a little bit easier, especially after what we saw on Friday. But I'm also going to give you guys a nice little segment on Jackson Hole on Friday. So we're going to dive in and do a little analysis of what Powell said, what the Fed is kind of leaning towards now, and how the landscape of the entire market has actually changed here short term. It's very, very different than a few years ago, and we're going to see what that could mean going forward. So you make sure you stay tuned to that. We might do that right at the open, depending on how this open goes. We'll obviously like to cover the open, but we'll do that pretty early on in the stream, so make sure you stick around for that. I got a whole breakdown on what was said during the speech, how you can interpret it, and what we're looking at going into the future. So you're going to want to stay tuned for that, especially if you're a little concerned or confused, I guess I should say, with what actually any of it really means. So I actually took some time this morning to try to make it more concise and a little bit easier to understand, because I know sometimes there's a lot of inferences that can be made based on what someone says, so you want to make sure you have a good idea of what things could mean. Anyway, let's get into everything real quick. Before we dive into the market, I do want to keep an eye on our Catalyst Watch, especially on a Monday like we like to do. Now, today we don't really have too much going on. You do have Fed Logan speaking towards the end of the day, but not too much today. Looking forward to the rest of the week. You do have consumer confidence tomorrow. Outside of that, not too much tomorrow. Pretty quiet there as well. Wednesday, you do have the 5-year note and NVIDIA earnings. That's the big one this week. Make sure you're watching that. That's after hours. I believe at 4:20-ish. Blaze it. The call, I believe, is later in the evening, though, but the actual results, I believe, are around that 4:20 time. Looking past that, we have Thursday. Don't forget, we have a holiday weekend coming up because we have Labor Day on Monday. So remember, especially after NVIDIA's earnings, we might see some volume taper off there, so keep an eye on that. I will be going live on Thursday. I'll mention that again later in the stream as well, but I will be going live on Thursday as well for you guys, so we'll talk about the end of the week and how NVIDIA reacted to their earnings, what to look forward to the end of the week, into September, etc. That'll be on Thursday. But for right now, on Thursday, we do have GDP quarter over quarter as well as jobless claims, so especially after what we just heard with Jackson Hole, we're going to want to keep a tight eye on that as well. But really, that's it for Thursday and Friday. I don't believe there's anything. I'm just double checking. Oh, I forgot. PCE is on Friday, along with consumer spending, and then Michigan sentiment, which you guys know I like. So overall, a pretty quiet week. The big landmine you don't want to step on this week is going to be NVIDIA earnings. Honestly, pretty straightforward. That's the one to watch more than anything else. Biggest name in the entire stock market. What is it? 10, 12, 13, whatever percentage of the S&P is NVIDIA. So you're going to want to pay attention to that. No matter which way it goes, you want to be aware of what's going on during that earnings call because it will affect essentially everything. If you just look at the SPY as a mark of how we're performing, right? Speaking of how we're performing, let's go on the daily here, and we saw this really solid green candle here after that Fed speaker, after Powell spoke at Jackson Hole on Friday. Now, if we zoom in a little bit here, let's go down to 10 minute. We had a sharp move up and basically just consolidated around the highs today. Or around the highs on Friday, I should say, where we got a little bit of bumpiness, but it was a consolidation. Now, typically when you get a hard move up or down with consolidation, that's not a bad thing by any means, nor should it be deemed as weakness. It's kind of like getting comfortable in a new price range. You're having price discovery. And that's essentially, we saw the bulls essentially hold the highs here. You defended that 640.30 low. I'm sorry, 644.30 low that you saw around midday at the close and bounced it back up to this POC. See that green dotted line there? On my chart around 645. Now, pre-market here, we're selling off a little bit so far, but I actually think we're going to see a continued move up today and tomorrow. But that doesn't mean we're out of the woods by any means. Now, I know that sounds kind of crazy, especially this candle. So having essentially, we'll call this 5 down days and having a big up day, it's pretty exciting, especially when you make a new all-time high on that big up day. On higher volume, from a regular technical standpoint, this would be indicative of a trend continuation, in my opinion. However, I have to ask myself why we saw that price action take place, and it's because of obviously a more dovish Fed, more dovish policy can lead to more of a higher return for equities, obviously. Now, we'll get into this when we get into our Fed portion of the show today. Near term, though, I'm still not buying this yet. I know it sounds crazy, and I'm not saying short, and I'm not saying be a bear or any of that yet, so don't misconstrue my words. What I am saying is this is still a risk-off environment. There seems like there's still too much euphoria in the market, and I'm the same guy who told you when we were sitting around here back in, was it mid-June? That was the time to be bullish, and I was right, and we moved up pretty good. Now's the time to still be cautious. Regardless of this candle, it's a solid candle. You're up 1.5% on the day. Beautiful, great move. Still be cautious, in my opinion. A few reasons why. Again, I want to save that for that segment later on, so make sure you stay tuned for that. But in general, if you're a day trader, you're probably just fine. You can still day trade normally. You're playing the price action. No real issue there. The issue, and where I'm saying you might want to lean more risk off, is if you're a swing trader or an investor. And we're getting to this point where day traders, I believe, actually kind of have an edge here where they can get in and out of the market like that, whereas longer term investors and swing traders may want to exercise, at least approach the market with some level of caution, especially at this current evaluation on the SPY. We'll go over that again, like I said, a little bit later in the show. But before we do that, let's swing over to our sectors and look at how things are going here in pre-market, since we got about 5 minutes until the market opens. Utilities down right now, energy down, consumer staples down, and also tech down. So that's interesting to see. As you guys know, I like to look at these top 3 sectors as my defensive sectors. These typically go red and tech goes green. That means the market seems more risk off, risk on, I should say. When tech is red and the defensive sectors are green, market's more risk off because they're leaning towards more defensive names. Right now, they're all red, which is interesting, but take into account what Friday's move was. Pretty big move for the market in general. We could see a little bit of contrition here, a little bit of a pullback. Wouldn't be insane, especially in the pre-market. But I do anticipate, especially with what the week we have, so keep in mind a few things here. We have to keep in mind that we have NVIDIA earnings and we're on a holiday week. So in my mind, that breeds stagnation with price action. So what does that mean? It means sideways to mild trend continuation. So I don't really anticipate the SPY to go anywhere dramatic. However, I do anticipate the trend to continue. In this case, continuing a bull trend here because it was a big FU to the bears after 5 down days, getting a nice green candle there. So I do anticipate some level of bullishness to sideways price action. I don't anticipate a big down day, a massive up day, but more cautious sentiment going into Wednesday. Post Wednesday night into Thursday, we might see a little bit of volatility and reaction. And then Friday is the one that I'm really interested in. That's why I'm going live on Thursday, because we are heading into a holiday weekend, so there will be more than likely lower volume on that Friday. So depending on how price reacts to NVIDIA's earnings and how price reacts on that Thursday, we can see the market kind of get bullied around on that Friday, whether for the good or for the bad. You might see the bulls get bullied or the bears get bullied, depending on how strong the trend is pushed. Now, it wouldn't shock me that regardless of how NVIDIA reports, actually, let's check right now what the options chain is anticipating. I don't have data here yet, but let's assume, what do we close at? 178. We'll assume the 177. So you're pricing in right now, your implied move is roughly $12. So $12 on that is roughly a 10% move. So the market is anticipating roughly a 10% move on NVIDIA. And actually, it's a little less. It's $12. You're at 178. We'll call it a 7% move. So a 7% move on NVIDIA. Let's assume we open at 178. That would be about $12. So 178 minus 12 gives you 166, and that gives you 190. So you're anticipating, at least as it sits right now, and this can change leading into Wednesday, but roughly about a $12 move on NVIDIA. A $12 move on NVIDIA would lead us to, let's see. Sorry, I'm just crunching some numbers in real time here. So the market's anticipating like a 10 to 12% swing either which way on NVIDIA. So the effect on the market that would have, let's pretend or let's theorize NVIDIA is 10% of the stock market, which it's somewhere in that range, right? That would be if we get a 10% move or implied move, the SPY moving a full percentage point either which way. So to put that into context, this Friday move, which was $10, was a 1.5% move. So theoretically, and again, this is all in theory, the SPY is going to move roughly between $5 to $7 on NVIDIA's earnings alone, or expected to move on NVIDIA's earnings alone. That's enough to break us and push us higher or reverse this Friday move completely with momentum into that Friday. So that's what I'm saying. Definitely a time to be risk off. Guys, the market's going to open here in 1 minute or so. Do me a quick favor, wherever you're watching in the entire world, whether it's on YouTube, X, or any other social media platform, interact with the stream, drop a hi in the chat. I know Negum said hi, good morning. Like the comment, like the video, wherever you are, like the stream. Follow me on X if you haven't already. Subscribe to YouTube. And once that YouTube channel gets to 500 subscribers, we are going to do this every single day. So make sure if you haven't already, pop over to the YouTube channel, hit that subscribe button. Thank you for your support. I appreciate you hanging out with me here on this beautiful Monday morning. Now, the market's open. We are at 644 on the SPY, a little baby gap down here in the open. Giving up about $1 of Friday's gains, but we'll see how we're going to perform here into the open. Good morning, Hatchet. Thanks for saying what's up. So we'll see how this goes. Let's check tech real quick. Looking like we're going to... Ooh, all right. IWM moving down a bit. Now, IWM is something I've spoken on this program quite a bit. And I mentioned over this 229.42 area, you got like $10 of headroom here where it should really continue to push. Will it? I'm a little trepidatious considering the environment. That's why I preferred if IWM could come down here to this 218-ish area into September, and I would have preferred getting along there to run it all the way to 242. So as of right now, doesn't look like it may happen. We'll see. It's going to be an interesting week to say the least. A holiday week with in my opinion, a huge catalyst right in the middle of the week is going to make it not for very easy trading for most people. I will like to reiterate once again, as a day trader, you're probably better off than as a swinger investment trader, at least in the near term. We'll talk about that coming up probably at 9:45. I got a whole segment on the Fed for you guys, what was said at Jackson Hole, kind of like how to interpret it. So if you already know what you're doing, then maybe you'll just reaffirm what you have, or if you have questions, you can ask them in the chat. But I really spent some time this morning trying to whittle it down and make it more digestible, because I know a lot of words are said and people just want to know what it means. So I'm hoping I did a really good job of that. We'll find out, or at least you guys will tell me how I did that in a little bit. All right, market pushed up to this upper LOI here at 644.15. We're actually opening right between these two LOIs here. Wicked beneath it, pushing back up here. It would suck if we just got pinned here in this like 60-cent range all day. I would hate that. It would not make my day fun. It's a possibility. Q's getting a little heavy here. IWM also looking a little heavy. The VIX, check out how we're doing. So we hit a low of 14.21. Obviously getting a little bit of a mean reversion here on the day. Currently around $15 on the VIX. VVIX did move down pretty dramatically, ticking back up. As long as your VVIX is sub 95, it tends to lead more bullish in terms of volatility, or how you should perceive volatility. So volatility is not necessarily, I'm sorry, I should say the market leans more bullish. So volatility is more leaning bearish here near term. This isn't updating for some reason. There we go. Full transparency, I actually have a volatility long right now open, which may not have too much fun with, but we'll see. And I have a spread long, and I have a directional calls on volatility right now, or I should say on UVXY right now. So we'll see how that plays out. Nvidia here selling off into the open here. It's probably where you're seeing your tech weakness. This is going to be a wild one this week, to be honest. It drew down, so if you watch the program, you know I said I wanted Nvidia to get between 170 and 175 pre-ER. In a perfect world, it stays like here. So even if you're a bull, you want it to stay here. You don't want it to go much higher. You don't really want it to go much lower. You got to 170. 170 to 175. You stay in that sweet spot for Nvidia. That lowers the market expectation of it being that it would continue to gain as it goes higher, without it really fully losing its bull momentum. So that's kind of what you want as a bull. You've got this 183.30 area that's a key resistance here on Nvidia, so you're going to want to watch that into the ER. I'm very curious to watch how it reacts this week. If I'm a betting man, it's going to float right here, essentially. It should come down a little bit more, but really in that sweet spot between 170 and 175 would be like perfect. Regardless if you're a bull or a bear, that's where the risk is like good both ways, in my opinion. Not that I'm saying, play earnings or anything, but the risk is better, I should say, both ways. And it's even better if you're a bull as that price comes down. I mean, if you want to be a super bull into earnings, you want it to come all the way down to this low here at 168.80, or even tap the 50 MA pre-earnings, which would be a pretty hard fall, to be fair, and would set the market back a little bit as well. But that would give you more headroom into the earnings, because as I explained on this program before, there's no doubt in my mind that I think Nvidia is going to blow their earnings out the water. My concern is how well they blow their earnings out the water. So again, if they say, hey, we want to aim for 5, right? Their goal is 5. They report 10. Well, at the current evaluation, the market may be expecting 30. So even though they beat based on, and I don't mean just beating on revenue or EPS. I just mean beating key metrics. Even if they beat all key metrics, it may not be good enough if that evaluation continues to climb higher and higher into earnings. So the expectations continue to rise if Nvidia continues to grind up into earnings. So you actually your risk actually goes down as a bull if Nvidia comes down a little bit into earnings. So that's kind of I feel like I should touch on that because I know not everyone watches all the streams, but especially with them reporting earnings on Wednesday, you want to keep that in the back of your head regardless on how you stand on the stock. Meta right now opening a bit down. Again, I'm not pretty bearish. I am leaning bearish on Meta as long as it's staying sub 770 and 777. 775, 770, 777 area. So we're about $20 beneath that right now. You want to be cautious here as a bull. You're forming what I like to call a sandwich when you're between your short-term EMAs and your long-term EMAs. You get pinched, and when you get pinched, you get popped either which way. So right now is a time to be risk off. This is actually setting up to support whichever way Nvidia gets pushed. So if Nvidia gets bullied to the upside, or gets pushed on the earnings afterwards to the upside, this is set up nicely because those MAs are squeezing it, and conversely to the downside. If Nvidia reports poorly, or at least perceived bearishly, this is setting up for a downside break here as well. So it's basically setting up for consolidation, I guess I should say, in the near term on the daily as those levels pinch. So especially if Meta comes down a little bit more, just like how I want to see in Nvidia, you're leading up to an explosive move where another big name like Meta is going to especially be affected by Nvidia's earnings, and it's going to, in my opinion, exaggerate the effect of Nvidia's earnings, whether bullish or bearish. Looking at Microsoft, exact similar setup here. You're sitting on the 50 MA, you're sitting on the POC on the daily, you've got the short-term EMAs coming down. This is the same exact thing. This is why I say you want to be risk off, and this is why also I'm saying you're probably going to see a choppy today, tomorrow, into Wednesday, because your Mag 7 names, or at least some of them, are setting up in this like pinch, as I like to call it, where the short-term EMAs come down, the long-term EMAs come up. Price action tends to get very tight in that range for a period of days before you have a break. And that seems to be the case here on Microsoft as well. Same sort of analysis I just gave you guys on Meta in regards to its effect on Nvidia. So now we went from Nvidia's 10% hold on the stock market to throwing in Microsoft, which now makes it whatever it is, 15, 20% or whatever in some of Meta's. So we're talking about all these companies getting pushed more than likely by Nvidia's earnings. And I know Nvidia isn't a proxy for Meta or Microsoft, of course, but it's kind of the canary in the coal mine, as I've said before. So if there is any weakness or any bearish signs there, technically speaking, the way that Meta and Microsoft are setting up could be bad. And also, conversely, can be very good, because you're having some level of retracement here. You came up from the highs on earnings, you came down, you grinded lower, you're back testing an area of support. And again, when these levels get tight, you will pop either which way. So even on a bullish reaction, you could support it here with both Meta and Microsoft. So either way, there's more fuel to this fire than may just appear on its surface alone. Google, on the other hand, as I've continued to tell you guys, has kind of been your stalwart for performance of the Mag 7 specifically. You want to see Google continue to push up if you're bullish on the Mag 7. When Google actually starts to push bearish and reverse bearishly, at that point, if you haven't gotten out of your Mag 7 names, you're probably too late. I know it sounds a little scary or whatever, but with where Google is, I mean, it should cool off, but I mean, once it forms a bearish trend. So once it comes down at this point under like 190, 106, and that's going to change as the days go on. But once you get down below that, you're questionably forming a bearish trend. At that point in time, all your other Mag 7 names are probably in a confirmed bear trend. So just keep that in mind. Your Google, if you want to hide in Mag 7, Google's probably the safe one, although it is at all-time high, right? It is at all-time highs. Yep, it's at all-time highs essentially. It has the most strength, in my opinion, from, or I should say in comparison to its Mag 7 peers. Apple isn't in a pinch like it is on with Nvidia and Meta. However, you are sitting in this range here where you have these three LOIs. You've got this 227.11, the 226.87, and this 224.37. If you want to extend it to the downside a little bit, you have the 200 MA here as well. So you're more than likely going to get pinned here as well. You guys know how I feel about Tesla. I see a lot of people posting how it's going to be an explosive move to the upside, bulls, blah, blah, blah. This is still a no touch for me. Until this thing cracks like 360 with strength, I am leaning more bearish than bullish. How I'm not putting my money on it because this is just a sideways battle right now. but this is not indicative of bullish momentum yet. And you should be very careful on people who are really, really pushing this on you, because the weekly and the monthly are at a very precarious point where if there is a candle that pulls it down to like the low 300s, you're going to flip bearish on your weekly and your monthly. So this is sitting at a very, very, very precarious point where one push down, like basically a 10% move down, which on Tesla's not too absurd, can push this fully into a bear trend on the weekly, on the monthly. And at that point in time, I will take a bear stab at Tesla, and I will let you guys know. But I'm not a bear right now. I'm not a bull right now either. This is just a no touch. And then Amazon, it's not necessarily in a sandwich, as I like to call it, but it is consolidating around this 222, 228 area. So the reason why I want to take some extra time going over those Mag 7 is mainly because it's a Monday, and I knew this was more than likely to happen, especially after Friday. We're not going to miss much, right? But I wanted to give you guys that layout of understanding. You understand there's a big catalyst coming up with NVIDIA's earnings on Wednesday. But I also wanted to highlight how the other Mag 7 names, at least that I follow, are sitting right now, and how that move from NVIDIA, again, whether bullish or bearish, could be exaggerated. And actually could lead to a harsher move either which way, whether bullish or bearish. So a normal explosive move, so to speak, could be even more explosive simply due to how the other Mag 7 names currently are sitting. And that's something you should consider, at least in this current environment. Now, I do want to roll into my Fed segment for you guys. I want to give this a few more minutes here. I like to wait till around 9:45. To kind of see if anything. This just popped up on my radar here. I'm sidetracking myself, but I like to wait till 9:45 to see if the market actually definitively picks a direction, especially on a Monday. But what I was alluding to is this just popped up on the radar that Trump is signing executive orders at 10 o'clock. That was not there when I read this, when I read my news blotter, like 20 minutes ago? So that was just added. And currently Trump is apparently speaking about South Korea and something about Intel. That's a whole kettle of fish we're not going to get into today. Yeah, speaking about South Korea. All right, I don't really care. We're looking at the high of the market here. See if we can break that on the day. Let's look at our Qs. Pretty flat. IWM. So if I'm a betting man and you want to hedge for bullish directionality, I'd keep focus on IWM. Like I said, IWM on the daily, as long as it's north at 229.42, has legs to 242.39. That was my goal when 229.42 broke. Because this week is this week, I don't feel that way. Like, I don't want to take the stab on it myself. But if you are looking at names to trade, I would at least lean more towards your small mid-cap names versus your large-cap tech names, because you're more than likely going to get a lot of choppiness on your large-cap tech, in my opinion. Really, any tech. Probably going to, I mean, look at these candles right here. Here's NVIDIA, Meta, Microsoft. Like, no one has, I mean, Apple here is getting a little bit of a trend, but no one really has much of a trend here. And it probably is going to lay that way because all of these companies are they're all hinging around NVIDIA. And they're all going to continue to hinge around NVIDIA because NVIDIA isn't like AMD or Intel or Taiwan Semiconductor. It is leaps and bounds beyond these companies. And essentially, NVIDIA's performance and how they do shows how well, theoretically, Meta could do, or Microsoft could do, or Google could do, or Apple could do, right? So its results impact potential future, I want to say estimations, that sounds dumb, but future impact of these names. So you want to be very careful about that as we head into Wednesday. We're going to roll into that segment here in just a second. I just want to pull up a few things here because I don't think we're going to be missing much here on the market. Like I said, you probably want to be very, very careful today and tomorrow and Wednesday. And after Wednesday, Thursday is probably the day where, especially as a day trader, you're going to make your money. Maybe leaning into Wednesday. But Thursday and Friday more than likely will continue Thursday's trend. So for me personally, if I'm looking to make my money this week, I'm I'm either in and out with scalps in general between today and Wednesday. Thursday and Friday, I can lean more aggressive, but still be risk off. So what I mean by that is lower size, but be more aggressive in entries. If that makes sense. So it doesn't mean oversize on entries or anything, but there should be more volatility. If there's more volatility, I can lower my size impact, so I can lower how much money I have at stake, because theoretically there should be a larger percent gain to make up for the difference of having lower size. So at least that's my opinion. At least heading into this week, I would more than likely avoid trading or minimize trading between now and Wednesday. Thursday and Friday is probably where you're going to want to strike while the iron's hot. All right, let's roll into this Fed segment. Before I do that, guys, I'm going to grab a drink of water because I am absolutely parched, and I'm probably going to talk for 20 minutes straight during this Fed segment thing. So you're going to hang out here for a second. I'll play on some nice royalty-free jams to pump up the jams, you know. And I will be right back. While I'm gone, if you do have any questions as it pertains to the Fed, I almost said Fed meeting, sorry, Jackson Hole or Palisade, feel free to drop them in the chat. And if you haven't already, do me a quick favor. I only ask you guys twice a stream. I'll ask you right now while I'm going to pop away real quick. Do me a favor, like the stream, share it wherever you are. If you're on X, go ahead and follow me. If you're on YouTube, drop a like on the stream. I appreciate it. And if you're on all the other social media platforms, do any of that fun stuff. And if you haven't already, please pop over to the YouTube channel, hit subscribe. Again, once we hit 500 subscribers, we are going to do this every single day. So if you enjoy the content and you want to see more of it, do me a favor, pop over to YouTube, hit subscribe. I will be right back, guys. Hang tight for just a we enjoy some early morning shredding, keep the energy up, keep you guys active and awake, some high energy movement. And as that was happening, the market went nowhere, went everywhere and nowhere at the same time, actually. Just price action just got wider, but we still went nowhere. Like I said, this is gonna suck if we just get pinned here, like here. It's not gonna be fun. It's gonna be a crappy day. In general, it's just not going to be a fun day to trade. Anyway, let's roll into the Fed segment. and I will record this for you guys as well. So if you want to go back and watch it later, I'll have it uploaded on my YouTube channel, so you can give that a watch if you want to recount anything that you might have missed. Give me 1 second to get that set up. So Jackson Hole was on. Jackson Hole was last Friday. Right. Jackson Hole was last Friday, and during that we saw Powell speak, and during Powell's speech there were a lot of words said, and you want to know probably what any of those words mean, so I've summarized everything. I boiled it down to 10 key points, and really wanted to focus on also how the mandate, or how the Fed is approaching things, is going to change going forward versus how it's been handled, and how that could affect the market here in the near term. So the top 10 points that Powell listed during his speech: jobs slumping. So we saw payrolls plunge down to roughly around $35,000 a month. That means the economy could be slower. You could see some slower growth there. However, the labor market was roughly balanced. So overall, we saw a balanced labor market. And again, I'm trying to summarize what was said and at least present it to you guys in more of a attainable way of understanding. Demand and supply for workers both really slowed, implying that there could be rising downside to employment risk in general, or risks. So that's an economy risk, and stocks, it's dovish because of how the Fed will handle that. So when things sound bad, it's actually kind of good, depending on how you look at things. Because if the economy's poor, the Fed has to kind of ease the brakes on being how tight they are, right? So that's a higher unemployment risk for the market right now. Inflation's still above 2%, so that's our third point. We're seeing consumption prices still pretty high. The economy's seeing higher costs in general. And housing inflation is still, or I should say is falling, while goods inflation is positive. So that leans a little more hawkish, but at least something you want to keep your eye on. I mean, getting back to 2%, which has been the benchmark, isn't really going to be attainable in the near future, but we're going to get to that in a little bit here. Fourth point is going to be the tariff effect. So higher tariffs are lifting the prices of goods. It's making things more expensive. I don't think anyone's going to really debate on that. However, the effect of this could be seen long term. We'll see. Temporarily speaking, on the economy, this is affecting everything. It's making things cost more money, which again leans more dovishly. So you understand how these things sound bad, but it means that things could be good, because it could mean that the Fed has to not be so tight on the economy with its rates, and it wants to ease rates to make it easier for people to breathe. That, however, doesn't help inflation. So it's a big tangled mess. But how you interpret this information, bad news is good and good news is bad, really, as it pertains to the Fed. Inflation risk, so that's your fifth point. Tariff-induced inflation could cause a wage price spiral, essentially. Powell said this is unlikely just because of how labor is sitting right now. I argued that this point was kind of saying that the economy had inflation potentially contained. Consequently, that is a hawkish point, right? That one's up for debate. You guys may differ on that opinion, but that's kind of how I see it at that point. The fifth point is the anchored expectation. So long-term inflation expectations remain well anchored around that 2% point. We talked about that earlier, and that's been the goal, essentially. The economy is trying to show price stability, and you could deem that more as a dovish point than a hawkish point. And for a lot of these, I wouldn't really see things as overtly dovish or overtly hawkish, with the exception of like one or two things, but more of like kind of open to interpretation. It kind of depends on how your macro view is combined with the view of everything else. So depending on your viewpoint, your opinion could vary on this. And you could let me know down in the comments or right now how you feel about that. But your opinion may vary on some of what I'm saying here. I'm just trying to distill what was said and kind of make it more attainable for the everyday man. That sixth point is that there's no lingering shock. So remember when you had how could you forget? Remember when we had COVID and the pandemic? The Fed is apparently no longer going to let a one-time price jump be persistent with inflation. I deem this as hawkish. This is debatable. So theoretically, if we had another at least based on this in a nutshell, right? In a vacuum, if we had another COVID event happen next month, the Fed could cut rates aggressively or pop them or raise them, whatever they got to do, right? They could raise them high or drop them, or if we had some sort of shocking economic event is the point. Don't want to say COVID as an example. We had some sort of shocking economic event. The Fed could react violently to said event without the idea of working on containing it long term. Meaning, we're still dealing with the effects of COVID, and the Fed's going to say, okay, remember that COVID thing? Get it out of here. We don't care anymore. We're just looking forward. And they're just going to continue looking forward. So, depending on your viewpoint, you could see why that could be troublesome. But in general, the Fed's just going to continue to look forward as it sets policy and not let a one-time price jump give off persistent inflation to the market. Or to the economy, I guess I should say. Seventh point is balancing the mandate. So near-term risks are now tilted toward higher inflation and weaker jobs. The Fed must balance its dual mandate as a result. This is more neutral. The economy is just cautious right now. Everything is saying cautious. What makes me cautious personally is when we get economic data from the government, they go ahead and revise it like 2 or 3 months later. That doesn't make me too confident because it's like, how can you even trust this information? But I digress. The ninth point is its policy stance. So right now, the Fed's policy rate is 100 basis points closer to neutral than it was about a year ago. So stance is essentially restrictive, but may warrant adjusting if the outlook shifts. So essentially what that means is the economy is looking to ease policy, so cutting rates, right? So it's dovish, right? The Fed is saying, hey, we're probably going to cut rates because of how this is looking, but that can change, right? So it's very, again, the no lingering shock thing, it's looking forward. So if data changes looking forward, we might, again, we're forgetting everything in the past because that's how we're moving now. Looking forward, if data shows that things need to be changed right away, then they could. And lastly, the framework update. And this is what I really want you guys to home in on. And essentially, this is what I'm going to zoom in on here. The Fed is going to return to its simple 2% inflation target. This is different from when we had COVID and the 2020 era kind of stuff. We're dropping the prior make-up overshoot strategy. So this is hawkish, at least in my opinion, mainly for stocks reacting more to the downside on this framework update. And the economy is going to be more inflation focused. So in my opinion, it's could be better for the economy. I guess that's to be seen. It's very debatable. Here's why. And I'm going to break down again this framework piece. So there's no more makeup rule. The makeup rule was previously if inflation stayed below 2% for a while, the Fed let it run above 2% later to balance out. So they allowed an overshoot to allow inflation to balance out either which way. So they said, hey, if we're under, then we're going to let it run under. And if we're over, we're going to let it run over as long as we anticipate it coming back to where it should be. Remember, inflation is transitory. That was kind of the idea at that point in time. So now we're going to skip that and just aim directly at 2% without catching up with the past misses. So if we're over, we're under, we don't care. 2%, that's the goal. So you can see why that could be problematic, and it could also be a good thing, kind of depending on how you feel about the economy. This leads into systematic targeting. So you're treating the risk of inflation being too high or too low equally. So it's more balanced in that response, or in that regard. You're not really favoring one side of being like more that inflation's too high or inflation's too low. You're looking at it really more pragmatically and more short term, which again, depending on your opinion, can lean more good for the economy or bad for the economy. It really kind of depends on you and your overall opinion. There's less focus on the lower rate trap. So the old rules that we had about worrying about situations when rates can't go lower, and this is called the effective lower bound, by the way. Now they downplay that to cover more scenarios. So I guess you can call that caution. And lastly, the framework update. And what's different about the framework update is this is allowing for quicker action to be possible. So the Fed can now raise rates faster if inflation hints at rising, even without the full proof. So even if the Fed feels like, oh, we could be having rising rates again, we could see rising inflation again, we're going to raise rates right away, even though the data's not fully there yet, they could theoretically do that with this like new framework. So that's something you want to keep in the back of your mind, especially as an investor. So I want to kind of hone in and compare the old one to the new one, and I have this kind of distilled down again to make it more easy to understand. So the old framework allowed for temporary higher inflation. So again, I want you to think back to COVID, how things were all out of whack, supply chain, everything was all out of whack, right? That old framework allowed for higher inflation after low periods to average out around 2% over time. That was the goal, right? We're going to allow it to go higher if it needs to go higher because we're only seeing it as short term. Remember, inflation is transitory, right? So we focus mainly on fixing the job shortages because the logic at that point in time is if we fix the job shortages, then we will fix inflation. That was at least the thought process. And it was designed for times of weak growth and lower inflation. So this essentially led to lower rate hikes during that 2021, 2020, again, that whole COVID-y time. The new framework is not allowing for averaging or makeups, right? We're not making things up. We're not allowing inflation to run high. We're not allowing it to run too low, whatever the case may be. It's going to be a little bit more strict, balancing jobs and inflation goals more evenly. So we need to look both at the labor market and where inflation is and make logical decisions based off of that. So this watches for the job markets getting too hot, which eventually could spike prices theoretically, and will act sooner. Overall, it is more of a stricter way to look at inflation risk while still supporting jobs and making the Fed less likely to keep rates too low for too long in high inflation times, which is very interesting. So you could see how this new framework can be better for the economy. The issue is we didn't resolve our issue. So this, in general, if we didn't have the lingering effects from COVID, and this is my opinion part, right? If we didn't have the effects from COVID, this is actually not a horrible policy. It makes sense. It's very pragmatic. It makes logical sense, at least in my opinion. However, we haven't fixed the problem. So now we're just taking the problem. We're really like, all right, we're going to take this cancer of a problem and we're just going to kind of deal with it and just kind of hope it goes away as we continue to pretend like it's not there. That's where the issue lies, at least in my opinion. Now, obviously, September, the market is essentially priced in a Fed cut, right? That could obviously happen. It may not happen. It could happen. It probably is going to happen. My question to you is that rate cut already priced in? We saw a hard pop on the IWM on that Jackson Hole speech last Friday, which is the index you want to watch as it pertains to for that Fed cut to come through, because those smaller cap names, as those interest rates drop, they're allowed to borrow money for cheaper, refinance debt. They have a stronger ability to last longer. These growth names can actually grow because they can borrow money and get cheaper money that allows them the opportunity to get even bigger, right? That's good for them. So you want to watch the IWM to get an idea of how the market is reacting to Fed policy, again, at least in my opinion. So you saw a strong reaction there, and obviously that reaction carried over to SPY as well. My question to you guys at home is this potentially front-running, I guess I should say, that Fed cut rate? And I want to harken back to this date right here on the 12th of August, where we got our first whisperings of a Fed cut, at least more like confirmed. It was at that point, I believe it was priced in at 100%. Now that dipped to like 80 or something in this little retrace, and now we're back at like high 80s. But we had that first move happen when the IWM was sitting around 221. So we're 12 points higher. Is it possible that from that point in time, the move could be baked in? And especially if we continue going higher, is that pop that is typically seen when the Fed goes from a raising rate environment to a cutting rate environment, is it already baked in? That's my question for you, and that's for you to ponder. My opinion, if we get and we continue to move higher here, especially into September, I would lean and err on the side of caution and say yes. If we get a back trace here, especially if we move south of 221, then I would lean on the side of no, it wouldn't be priced in. But the higher we go, the higher at least in my opinion, near term, the higher we go, the higher the odds of that move already being baked in. Now, I want to leave you guys with this. The Federal Reserve's updated policy appears sustainable because it promotes more balance, right? As I alluded to, it's a better way of how we should look at inflation and handle inflation, but it didn't forgive the past, right? Preemptive responses to inflation and employment risks across diverse economic scenarios essentially This will reduce the likelihood of prolonged imbalances. So essentially what I'm trying to say here is these preemptive responses to inflation and to employment, no matter what the scenario is a better way to move forward, so we don't have a 2021, 2022 kind of thing. However, this doesn't clean up the mess from the pandemic, though. So that's my whole take on Jackson Hole and what we're kind of doing right now. Now, this week's a little bit of an interesting week. We're coming off the reaction of that big move from Jackson Hole. We're heading into a holiday week with Nvidia's earnings in the middle of the week. So for me, at least the way I'm looking at the market, we're not out of the woods either which way. Not a bull, not a bear, but this is definitely a time, I think, to be risk off on the market. But let me know what you guys think about Jackson Hole. Let me know what you think about the market right now down below. What do you guys think about that? Was that concise? I spent about an hour and a half trying to summarize the speech. I was taking notes while he was talking, and I'm like, man, how can I make this palatable? Powell likes to say a lot of words, essentially. So I hope that was palatable. If you have questions, please ask. Overall, I think the new Fed policy, like I said, is good. I don't think it's bad by any means. The issue is, and again, it stays the issue, we haven't fixed the problem. So it's like you have I guess I alluded to it in the video I just recorded, that segment. I alluded it to it being like a cancer, right? You can still live with cancer, but you still have cancer. It's kind of, and I know that may be like a little bit of a harsh simile or a metaphor. But it's kind of what it is. It's we can move forward, but we still have this albatross that we're carrying around with us that hasn't been resolved. I don't know the solution to that. I'm not an economic scientist or anything like that. Is there an economic scientist? I'm not an economist. I'm an economic scientist. What am I talking about? So I don't know. If you guys have opinions, you can let me know in the chat right now. Feel free to discuss. The way I see it, though, as I said, and as I've been saying all morning, especially this week, it is a time to be risk off, especially through now to September, which we're already almost in September. And I should say mid-September, so like FOMC time, and really to the end of the month. This whole next month, essentially, I'm being very, 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 very careful because of where the market's sitting, and I want to go back and bring up markets at all-time highs, gold's at all-time high, Bitcoin's at all-time high, the dollar is right, inflation is at a high. Something's got to break. Okay, inflation's not at a high, but inflation is high. Something's got to break. And I don't know what is going to break, but I don't want to be holding the bag. And I want to be very careful because I've seen the market react overnight on some bad news. I'm sure you all have been there. I don't know if you guys remember COVID. Let's go back to that real quick. Let's take a trip in the time machine here. Is that 2021, right? Take a trip in the time machine. Or technically 2019. Yeah, here it is. Because I remember it was March. Right, or February into March. Yeah. So overnight, and this isn't even like the drop, but this is the start of the drop. SPY closed at 308. Next day it opened at, 298. So you lost 10 points overnight. At that point, that's a 3% drop, roughly, in one session overnight. And then you dropped another 10 points the next day. This was the beginning of a sharp pullback, right? I'm not saying this to scare you guys. What I am saying, because I don't think this is going to happen. Let me get that out there right now. I don't think we're going to fall 30% on the SPY. That's a little much. I do think, as I put out in that SPY video, and you can see it's on my channel, it says SPY to 700. I do think it makes a lot of sense for a multitude of reasons is getting back to this 590, 570 at the worst, but this 590-ish level. And you can see without even all my lines here, that's where your POC is, and that's where the 200 MA is. getting a pretty stark drawdown, a real correction. Remember, a correction's about 10% on the market. So correction right now would be roughly 60 points, right? That puts you right at 580, 590. That puts you right around here. A real correction here on the market near term. You could even potentially, and I say down to 570 because you have this gap here unfilled from 5.9. I'm personally going to start longing around 610, a little bit sub 610, depending on how technicals look at that time. And I'm going to deploy my final trough of long equity at that 570 point. But I still think we draw back here. I know it sounds crazy. I know everyone on social media stays bullish and everything. But if I have that, if that's even in the realm of possibility right now, I want to stay very careful. Yes, I might miss an upside move. Yes, the market could just push to 700. But you know what I didn't do while the market was pushing to 700? I didn't lose money, right? I could still make money. I still have long equity. I'm still exposed to the market. I just have some in cash right now, right? I have a good amount in cash. I'm over half in cash on my personal portfolio. But I don't have any exposure. I do still have exposure, so I could still make money while the stock market goes up. And if it fails, then everything I have that's long equity has stops in place. I'm prepared. There's like one or two names where I'm just going to long no matter what. Like there's very few names I have that I'm really, really concerned about. But everything else has stops on. Worst case scenario, I'm going to be fine. I'll get stopped out if the market continues to drop. Then I could get into those same names a lot cheaper. And that's what I think a lot of bulls don't really understand here. When I say risk off, again, it's not being bearish. It's being almost neutral. You're looking at the market from a risk standpoint, not a bull or a bear standpoint. And I see too many people on social media being bullish, but not defining risk. And that's the painful thing, because you need to define risk in this environment. And by defining risk, you're actually able to see real growth. If there's a realm, there's a possibility of a volatile move potentially on the market. And when I say volatile, we're just saying a healthy retracement. It's a 10% correction. Everyone's going to poop their pants and run around like the market's dying. It's the end of the world, whatever. But when that comes, you'll know that's a time to buy. And that's also technically where a correction would be, and technically where there's a lot of support and a lot of rationale for there to be a bounce or some level of a move there, versus buying literally at all-time highs after, barely any retracement. That's why I was like stuttering. I'm like, you had a little bit, this 2-day drop here, and that was 20 points. Good little drop there before getting a nice little tiny rally again. But we're hot on the market. Continue to say that. It doesn't mean we can't get hotter. Like I said, we could push all the way to 700 right away. But I think if you're an investor, you're a smart investor, you want to be very cautious. That's why I said right now this environment favors day traders. The market's still cautiously bullish, and Nvidia's earnings can change that, but between now and Wednesday, the market's still cautiously bullish. Now, I do anticipate the market mostly to chop, but in individual names, you're more than likely okay being a bull. That's why I said day trading, you're probably just fine. It's swing trading and the investors I'm more concerned about, the people who are investing more long-term, because a sharper retracement, and I say sharper meaning like an actual correction on the SPY, I think is necessary before going higher. And I've explained that on 2 separate videos, so I'm not going to do it again. But I feel like that is necessary to happen before the stock market can actually have legs and continue going higher. Toby says the whole structure of the market still reminds me of 2018 yearly. Early pullback due to Trump tariffs, then rallied to all-time highs, and even steeper pullback in September with the China tariff escalation. I don't think we're going to get a steeper pullback. So based on that, which we can go back, we'll look at the chart in a second here. But just reading words here. Based on that, you look lower than 480. That would be an actual bear market. Let's go back to 2018 and zoom in specifically on what you're talking about here, Toby. We'll go on the month. 2018. So the highs in 2018, because we're just looking at the monthly candles here. Well, I'm assuming you're talking about this. So, and I don't remember exact dates, so I said I'm assuming you're talking about this because that's where the real pullback is there. You're at 264.54. I'm assuming you're referencing this drawdown or this drawdown even. Actually, no, you're right. This is exactly what you're referencing. So Toby's referencing a pullback, which is right here. Then a rally to all-time highs, which is here, which you could see on the chart. These are monthly candles. And then a deeper pullback. That deeper pullback was 225.23, 212. So another 15 points lower, but at the time SPY was trading around 220, or sorry, 212, 220. So another 10% lower than the previous lows there. That's a hard one. Let's zoom in on the weekly and see how it looked. I was working at a bank during this time. I remember this. Very familiar. This is what you're talking about. So yeah, you want to look at January 2018 and then again at September 2018 and then this downfall move here. I don't think, in my opinion, will change when we get closer. Let's look for the correction first, and then we'll go. Toby says, let's hope it doesn't repeat like that. Yeah, let's go for the correction first, then take it day by day. Because you can even see real time here, and this again, these are weekly candles. We consolidated around the 50 MA and the POC here for 1, 2, 3, 4, 5, 6, 7, 8 weeks before breaking lower. And basically breaking that range there. And that was another 20 points lower out of that range, the bottom of that range. So you still could have defined risk here and still been okay. And you got pretty close there to the 200. Yeah, that's a hard comparison. I don't think it's coming like that. It just looks very similar, and the reason was the same. Right. It does look similar. I see what you're talking about. Because you had to move up, pull back. So what Toby's saying is you had that move up on the market, so the market was bullish. You had a pullback for some reason, in this case, Trump tariffs. We're comparing it to normal time now, right? And then you had a continued move up again to make a new all-time high, because you broke that old all-time high here, before getting at least a correction back to those lows and breaking even lower. So putting that into real time, saying that would move us to 480. That would give us, on the weekly, if we do break that low, it would definitely give us a 200 MA tap. I don't even know. We tapped it in 2022. I was going to say, I don't know how many times we tapped it. We tapped it during COVID. And that's it. Well, and in 2011. And we actually broke under it with the financial crisis. I wonder what the monthly was. I've never looked at the 200 MA on the monthly. I've never thought to, I guess. So once we get enough data here, it starts at 2010. So on the monthly, it's never been broken. Interesting. It's not going to come up much more than this because this is a monthly time frame, so you might get like 275, but that's way too far out there. Yeah, that's an interesting point of view. I don't think it's going to repeat like that. That would be a very stark fall. We're talking, we would need more. Hold on, let me do some math here. We would need more than what I'm concerned about, I guess I should say. Let's see. Actually, let's do it like this. Yeah, it's going to be messy. Hold on. Oh, I did do my math right. So getting down to where the 200 MA is right now, it's about 27% retracement. That's stark. I guess it's not impossible. It seemed worse like that. If we get all the way to 400 here, let's say. Boop. Let's go to 400. Oops, wrong way. I'm looking at this low here. 38%. Man, that'd be crazy. That wouldn't be fun. What's that put us? That's the weekly. Yeah. I don't see that happening. However, what I will say, now that I'm staring at this a bit more, I don't see it happening. At least right now. Caveat. At least right now. I don't see it happening. Because you had this... Toby says fearmonger, Toby. You had a base down here. So, all right, let's zoom out. COVID, rally. Bear market, and then we built some level of base, rally. A little bit of a retracement there, continued rally. This is a very sharp drop from the tariffs, like a very sharp drop, and it's reminiscent of something like this. So I would counter your thought process, Toby, with looking at how COVID was at that time with such a sharp gappy drop, and it's very similar to how we see on SPY. So I would say, or how we saw with the tariffs. So I would actually make this more reminiscent of this move. COVID to mid 2022. That's what I see up here. This is your COVID, your mid 2022. I'm sure if we mapped it out, is it almost exactly the same kind of retracement. Actually, let's do it. Let's go from the highs here to the lows here. And let's see how I'm roughing this right now, right? It's not super accurate. Wow, it's a 26% retracement? Ay caramba. All right. That would put us back at the bottom of the tariffs, I believe, what we just looked at, right? 26%. Yeah. Never mind. Okay, so I mean, at least in terms of price action, then, not percentages. In terms of price action, seeing a steep fall like this, grinding to the top, and then getting some level of retracement back to some level of this range here. Here, we'll use a fib retracement real quick. So that brings you your 0.328, maybe your 50% retracement. So let's play a game here and see if that fares us any better. Okay, so your 50% retracement would give you 560. I can't even read that. Hold on. Now this makes more sense. Here, get out of the way. Move. Okay. Your 50% retracement gives you 563.44. Your 0.382 retracement gives you 583.04. So that's like, again, the bottom of the range was around that 570 area. This would support that thesis then. So I would counter your fearmonger thesis, Toby, with looking at the 2022 drop, how gappy and how severe that was before getting that sharp rally, a la what we saw here with the Trump tariffs, and then it's a much shorter time frame, seeing that retracement here, again to that 0.32, 0.5% retracement on the fibs, to that zone right here. Which actually, now that we've said that, and now that we've done this live, I'm going to make that a thing. I can't see. It's all jumbled. We're going to make that a thing. 40, 80, 30, 480.38. That's the highs. Good. Make it yellow. We'll add some dotted lines there, and I'll even bold it a little bit. There we go. Yeah, this is a cool way to use fibs, I think. I like this. This supports my thesis. I got way too many lines on my chart now. But this supports my thesis, essentially. I don't think you get to the GP down here, but I do think it's very realistic. And that gap is also right between these two fib areas, too. So a lot would support that thesis for a pullback, in my opinion. The difference was the second catalyst. So I say it doesn't come. It would be more likely like post-2020. Right. Yeah, I mean, that's at the end of the day, that's what it is. Ultimately, man, look at the market today. Nothing. I'm telling you, stay away from the market today, tomorrow, into Wednesday. It's not even worth day trading. Unless you're day trading individual names that have momentum, don't touch SPY, don't touch Qs, don't touch IWM, unless you're like in and out scalping, anything like that. You're just going to not have a fun time. Yeah, depending on the catalyst. So our catalyst that we have heading into September, the first potential Fed cut, and I should say the reaction to said cut. That's very important. We start out this week with NVIDIA earnings. That's extremely important. The last thing I want to touch on would be the economic data we receive now through that Fed meeting, and and what is said after the Fed meeting. Because the way that the economic data is perceived theoretically with the new framework is different than how it's been perceived, at least in recent years. And I made this, I made a voice recording for our members over Exclusive Trading in our Discord community, about how the playing field has changed. And this is something you got to keep in the back of your head. The market of yesterday, literally Friday, and the previous weeks is now theoretically different because of how the Fed is looking at inflation. So because that framework has changed, how we look at economic data theoretically has also changed. Consequently, the effect on the market theoretically will be different than it has been. So that's something you want to keep in the back of your head going forward, because the whole playing field is now different, right? The playing field hasn't been changed. Again, I'm referring to the playing field as like the Fed goals and Fed framework hasn't been changed, and now it has. So now that it actually has been changed, we need to see, especially in this first month, so between now, and I'm saying month in terms of OPEX terms, but between now and I'll say the end of September, and I'll even include October's Fed meeting because that would be like the first real full month of a completed, like completely new information theoretically. How the Fed speaks about inflation, how the Fed looks at the data, and how the Fed reacts to the data, because how that was done in the past could be very, very different than the future. And, as I just said, the effect of how the Fed looks at it, it could be wildly different and change the effect on the stock market as a whole. I will summarize with this. I will continue to be probably one of the only traders, investors, social media influencers that are online right now that tell you to consider environments to be risk on and risk off. Not a bear, not a bull, not a whatever's in the between, not a pig because you're not investing aggressively, but to be risk on versus risk off. And this, considering the environment, is a risk off environment. I don't care if I'm bullish short term. I don't care if I'm bearish short term. You know what I'm not doing is putting all my money into the market right now because the risk outweighs the reward currently, where either which way I could have a really bad time. That's not the time I want to be aggressive in the stock market because there is something called uncertainty. Now, typically, in periods of uncertainty, the market tends to go down. Tends to. May not always, but tends to. In general, as an investor, and think about this from a logical standpoint, wouldn't you always want to be more certain with your investments? Wouldn't you want there to be a lack of uncertainty? The logical answer is yes. So don't you think other people want to feel the exact same way as well? Probably. So that's what I would challenge you to think of when you're trading in this environment. That's why I said day trading, you're in and out, whatever, you don't care. We're actually, in this scenario, better off being more risk on as a day trader than as an investor. That's a crazy statement, right? Because day trading a lot of people suck at. But the important part is managing your sizing. So, for example, if you typically put 10% of your money into an equity trade, you don't want to put that same 10% into a day trade. Maybe you put 1%. Right? So you could still make some money in the interim, and just you change your risk, you change your sizing on how you approach these scenarios where you look for opportunity. I just wouldn't be putting more of my money on the line right now in general. I'd rather sit in some cash and wait for better opportunities to go risk on, because at that time, if you're risk on right now and you get blown out, guess what? When the market offers an opportunity, you have no money to take it. You don't want to be that person. So I would rather be risk off. I'd rather wait. I'd rather be patient, because the long game's the end goal, right? The long game, winning at this game at the end of the day, months, years in the future, that's the end goal. Sure, the daily wins are great and all, but week after week, month over month, compounding gains, that is how you actually make this long-term sustainable. When you are a trader and you have a 99% win rate, but your sizing is completely whacked out of control, you full port everything, that 1% of the time, you're always going to blow your portfolio. Always. Doesn't matter. You could be almost perfect, but a loss will come. And the one time that loss doesn't come, or the loss does come, and you don't control that loss, you will lose everything. That's, I think, what I want to end on today, guys. Be careful in this environment. Please be smart. I know trading sometimes can be very tempting. And I abhorrently hate when people refer to the stock market as a casino. Like, you sound like an idiot. Stop calling the stock market a casino. It's not a casino. If you treat it like one, it can be, sure. But at that point, you're better off either going to a casino or going to your local gas station and buying scratch-off tickets. If you're any modicum of serious about actually trading the market, then you have to treat it seriously. Don't treat it like a game. Respect every single dollar that's in your account, because if you don't have any money, then you can't make more money, guys. Sorry, it doesn't matter how fast you make it. If you lose it just as fast, you got nothing to make money with. That's how this goes. So with that, I bid you adieu. I hope you guys enjoyed today's show. I hope you guys learned something. I hope that little Fed segment worked out in your favor. Be smart. I will remind you that I'll be live again on Thursday. We'll cover the NVIDIA fallout. We'll see where the market sits at that point. But until then, please be very careful between today and Wednesday. You're probably going to get chopped up again unless you're trading individual names that have some sort of momentum or volume behind them, and you're being very risk managed. With that being said, guys, some say you need an edge to trade. I like to look at things from a different angle, and that's always what you get right here on the Atomcash Angle. Have a great rest of your day, guys, and remember, precision beats prediction every damn time. I will see you guys on Thursday at 9:15.
The time has passed, and that's a wrap. You're on with the